For most of American history, money was not just paper and promises. It was real. It was metal. It was something you could hold in your hand, feel its weight, and know that it had value. Gold and silver formed the backbone of the United States economy, and this system of backing currency with physical metal was called bimetallism. This idea came from the Coinage Act of 1792, when the founding generation of Americans debated how to create a financial system that people could trust. Silver coins were everywhere in daily life: quarters, dimes, and half dollars. These were not just pieces of metal stamped with government approval. They were actual silver. If you melted them down, the metal itself could be sold for money. If you saved these coins in a jar, you were not just storing currency. You were storing real wealth that would hold its value for generations. Farmers put silver coins in metal boxes buried on their land. Factory workers dropped silver coins into glass jars kept on kitchen shelves. Banks filled their vaults with these metal treasures, and the entire American economy rested on this simple idea: money had to be backed by something real. For more than a century, this system worked. Americans believed in their money because they understood what was behind it. The metal was tangible proof of value, a physical guarantee that their savings were secure. This confidence in the monetary system created unprecedented economic growth and stability. Families could plan for the future knowing that their savings would retain purchasing power. The ability to pass wealth from one generation to the next became a realistic goal for ordinary Americans. But by the early years of the 20th century, something started to change in the American economy. Industrial demand for silver was rising rapidly. Factories needed silver for manufacturing and technology. Governments around the world were printing more paper money than ever before. The financial system was starting to stretch beyond the amount of metal that actually backed it. Then came an event that shook the entire world economy and changed everything. The Great Depression arrived, and suddenly the government had to rethink how money worked entirely. The Great Depression was more than just a bad economic year. It was a complete collapse of the financial system. Prices fell so rapidly that goods that cost $1 one month cost 50 cents the next month. Banks that had been trusted for decades closed their doors forever, and millions of people lost their life savings in a single day. People were terrified of the future. They stopped spending money on anything except the bare essentials. They pulled their savings out of banks because they did not trust that the banks would still exist the next week. They hid coins in mattresses, buried them in jars in their backyards, and locked them in safe deposit boxes. Many of those coins hoarded in mattresses and buried in yards were silver coins. This created a strange and difficult problem for the government. The American economy works like a giant engine, and for that engine to run smoothly, money has to move. But in the early 1930s, Americans were so scared that they pulled their money out of circulation and hid it away. This made the economic crisis even worse. The government needed more money flowing through the economy to restart the engine. Meanwhile, on the other side of the world, global silver markets were collapsing. Countries like China had built their entire monetary systems around silver-based currency. As the price of silver fell, financial chaos spread through Asia. American policymakers in Washington faced a complicated question that would reshape the financial system. What if the government took control of the silver supply? What if they could buy massive amounts of silver and use it to stabilize both the American and global financial systems? In 1934, Congress passed a law that few Americans paid attention to at the time. It was called the Silver Purchase Act, and President Franklin D. Roosevelt signed it into law during his first term. The goal sounded reasonable and even simple on the surface. The government would buy huge quantities of silver to raise prices and expand the money supply. But the scale of what happened was absolutely massive. The U.S. Treasury began purchasing silver from around the world. Traders in London sold silver. Mining companies in Mexico shipped silver to American ports. The Treasury sent money across the globe, buying silver wherever it could find it. Eventually, the government also began buying silver directly from American citizens and American companies. Silver certificates, special paper money that could be exchanged for actual silver metal, were gradually pulled out of circulation by the government. These certificates represented a direct promise from the United States government that the holder could walk into any bank and receive physical silver in exchange. As the government bought more and more silver, the Treasury vaults became massive warehouses of gleaming metal. The United States government became one of the largest silver owners in the world. By the end of the decade, The treasury held billions of ounces of silver, fundamentally transforming the precious metals market and reshaping global trade patterns. But this was only the beginning of the story. This was the first time the government seized American silver, though most people did not realize it was happening. The second major shift in how America handled silver came 3 decades later, in the 1960s. Something unexpected had happened over those years. Instead of falling, silver prices started rising again, and they rose fast. This created a problem that seemed simple but was actually very dangerous for the entire financial system. Think about it from the perspective of a regular American in 1960. You reach into your pocket and pull out a quarter. The government says this quarter is worth 25 cents. But because of rising silver prices, the silver metal inside that quarter is now worth more than 25 cents. So what would a smart person do? A smart person would take that quarter to a metal trader and sell the silver for more than the face value of the coin. You could make a profit by simply melting down your coins. Some Americans started doing exactly that. Other Americans realized that silver coins might become rare and valuable in the future, so they started hoarding them. Collectors began seeking out rare coins. Investors started buying rolls of coins as an investment. The coins were disappearing from circulation. Shopkeepers complained that their cash registers no longer had enough coins to make change for customers. The government realized something alarming. If this trend continued without change, America could literally run out of coins. In 1965, under the presidency of Lyndon B. Johnson, the United States made one of the most dramatic monetary changes in its entire history. Congress passed the Coinage Act of 1965, and the government made a decision that would be implemented immediately. Silver was removed from most United States coins. Dimes and quarters that used to be 90% silver were suddenly made from copper and nickel. These were cheap metals that had very little value. The government printed new coins made from these base metals and released them into circulation. Americans quietly pulled the old silver coins out of their change jars and out of cash registers. Collectors actively sought out the old silver coins and stored them carefully. Investors bought bags of old coins from banks, understanding that these would increase in value over time as the silver price rose. The government stopped making silver coins altogether. The transition happened so smoothly that most people barely noticed the fundamental change to their everyday currency. Few realized they were witnessing the end of an era. But the government was not finished reshaping the monetary system. The final major move came in 1968. For decades, Americans had held silver certificates in their wallets. These certificates were promises from the government that you could exchange the paper for real silver metal. In 1968, the government ended the right to redeem silver certificates for actual silver metal. If you held a silver certificate, you could no longer take it to a bank and receive silver in exchange. The link between everyday money and actual silver was officially broken. For the first time in United States history, the currency system no longer relied on silver at all. America had entered a completely new era. This was the era of pure fiat money. Fiat means by decree or by command. Fiat money is money that has value only because the government says it has value, not because it is backed by metal or any physical commodity. This fundamental shift represented one of the most consequential moments in American economic history, though it passed with surprisingly little public fanfare or discussion. The average citizen did not grasp the magnitude of this transformation or what it would mean for the future of personal wealth and financial security. Journalists barely covered the change, and financial experts offered little explanation of the implications for ordinary Americans. Looking back at these 3 separate moments in American financial history, several important lessons emerge about how money systems change. The first moment came in 1934 when the government accumulated massive amounts of silver through government purchases. The second moment came in 1965 when the government removed silver from coins and replaced it with cheap base metals. The third moment came in 1968 when the government ended the ability to redeem paper money for actual silver metal. Each of these steps moved the American economy further away from commodity-backed currency. In the old system, money was backed by physical metal. If the government wanted to print more money, it had to find more metal first. In the new system, money is backed by something much more intangible. It is backed by trust. It is backed by trust in the government, the Federal Reserve, and financial institutions. It is backed by the collective belief of hundreds of millions of people that the paper and digital numbers in their bank accounts are worth something. This transformation raises a fascinating question that echoes through the halls of modern finance. If the rules of money could change this dramatically once from a system backed by metal to a system backed by trust, could they change again? The historical record suggests that yes, they already have changed many times. Not just once, but many, many times throughout history. The ancient Romans used to make coins from precious metals, and they slowly debased the metal content as the empire ran out of silver and gold. Nations during wartime have printed money without metal backing to finance their military operations. The United States itself has abandoned the gold standard multiple times. In 1933, gold was taken out of the monetary system. In 1971, President Richard Nixon ended the last connection between the dollar and gold. Throughout history, whenever governments faced severe crises, they changed the rules of money. Sometimes the changes were announced openly and debated publicly. But often, the changes happened so quietly that most ordinary people never fully understood what had happened. The real question is whether we would even notice if it happened again. Future historians may look back at our era and identify dramatic shifts that we failed to recognize in real time. Digital currencies and cryptocurrency represent new frontiers in this ongoing evolution of money. The story of silver in America is not just a story about coins or metal, or even financial history. It is a story about how financial systems evolve and transform over time. It is a story about how governments reshape the rules of money during times of crisis. And it is a story about how these massive changes often happen so quietly that most people never notice them until long after the transformation is complete. When the government removed silver from coins in 1965, the average American probably did not understand that they had just witnessed one of the most important monetary changes in the nation's history. When the government ended silver certificate redemption in 1968, most people probably accepted the change without thinking too deeply about what it meant. By the time people understood that money was no longer backed by anything physical, the new system was already fully entrenched. The government had successfully transformed the entire monetary system without causing a revolution or even much public protest. This is the real power of understanding financial history. By learning how money has changed in the past, we become better prepared to understand if and when it changes in the future. By remembering that the rules of money are not permanent or natural, but are instead created by humans and can be changed by humans, we maintain a healthier skepticism of financial authority. As we move forward into an uncertain economic future, the story of silver serves as a powerful reminder that the monetary system we take for granted today is not permanent. It can change, it has changed, and it will probably change again. The question we must ask ourselves is not whether these changes will happen. The question is whether we will be prepared to understand them when they do. Will we pay attention to the slow transformation of our financial system, or will we sleepwalk through it as so many Americans sleepwalked through the transformation from silver back to fiat currency? Will we demand transparency and debate when the government wants to change the rules of money, or will we accept these changes passively? The story of America as 3 times seizing silver from its citizens tells us that the answers to these questions matter far more than most people realize. Understanding this history empowers us to make informed decisions about the future of money and our financial security. The next time the rules of money change, we must be vigilant and aware.